All right, term sheets. Now we're going to look at a typical term sheet to illustrate how this works. They're legally non-binding. And people say, that sounds weird. We're going through all this work for something that's non-binding, that's not enforceable. The answer is yes. The reason is we want to describe and discuss and agree on the business terms and legal terms up front before we spend all the time and money to generate a multiple 100-page document, which is a definitive agreement. We want 1 or 2 pages that really summarize, and if there's controversy or things that we can't agree on, let's identify those and nail those down now. So that's what a term sheet does. Next is that there is the definitive agreement. In this case, it would be a preferred stock investment agreement, and that would be binding. And there's a lot more time and money and effort to do that. But that's after we've kind of gone past knowing that there's something there, and we're all moving together to make this happen. All right, so I'm going to look at a fictitious term sheet. I call it skin deep fashions, picking on the Kardashians a little bit. This is a typical looking term sheet modeled after some actual term sheets. So it would say, what is the company? What is the entity that's being funded? Here it's a skin deep fashion company. It's a corporation incorporated in Delaware. Delaware is a popular place for corporations, both public and private, because that state has the most favorable laws for the company. States like California are actually not anti-company, may feel anti-company, but they are definitely pro-consumer. So companies feel that if they go to court in California, they'll be fighting more of an uphill battle than if they were to fight a battle under the laws of Delaware. Second type of security, investors that are venture capitalists or angels will do preferred stock. The reason for that is a preferred stock can be tailored. The actual rights and privileges of that investment event can be tailored to the investors for that round. And you don't have to agree to what has already been filed, perhaps many years ago, for the common shareholders. It also provides a way for you to customize the rights so that you can tip things in your favor as the venture capitalist. And that's what the term sheet actually lays out. What are these little extras that are provided to protect the venture capitalists and their investors? Next is the money. How much money is the offering? In this case, it's $1 million financing. That's fine. There's $1 million coming. However, there's more to it. There are conditions. The amount will be released in 2 tranches. A tranche is just a block. So the first block is $600,000. It's going to be when the team is hired. Oops, now you don't like my team. You have to hire more people. Gulp. That's one of the terms. Second is $400,000 is upon the first release of design drawings. Well, if you're a fashion company, we want to see some fashion. So you'll get 400 at that time. So what's occurred here is the venture capitalist is committing to a number, but they're wanting the risk to be lower before they put in their money. So that's part of how tranches work. It has an agreement for the amount and the conditions under which the money moves. And then as those things happen, you get your money. In this case, 2 tranches. Not all VC documents and fundings have tranches. I'm just giving one just to show the possibility or the complexity of tranches. Item number 4, closing date. Here, August 15th in year 1. That's just to set a target. We will work diligently to try to get to that date. Next is investor group. Who is investing? So here we have the Hultian VC firm acting as a lead with 700, and the co-investors will contribute the rest of the 300. What this means is the entire negotiations will occur with the one VC firm acting as lead. So there may be 2 or 3 or 4 or some other number of people that will chip in for the $1 million. However, one will negotiate on behalf of the entire class of shareholders. Next is valuation, and here we get to the valuation we've already learned in class called pre-money. So the pre-money is $1 million, which is what the company is worth now before the new money from the VCs come in. So the math is quite simple. The pre-money of $1 million is what it's worth now. Congratulations, you've established a company worth that much. We as a VC firm will add $1 million. So now the firm has $2 million. $1 million from what it's accumulated to date in its abilities and accomplishments, and another $1 million, which is cash that we will put in as an investment. So the post money is 2. So pre plus the raise or new money equals the post. Next, number 7, conditions to closing. There could be many conditions. Here are again some examples of what you might see. The first is the intellectual property has to be acquired so that the company has the rights and privileges for all the patents that will be necessary for the business. And if it doesn't have it, then it will get those nailed down before the VC will fund it. In the US, for many years, it's no longer true, but in the US, companies could not be the patent holder. The patent must be granted to a person, an individual. Then the person would then assign the rights of the patent to the company. And that's what we're talking about here, is you may have had an inventor who worked it up in your lab or in the garage in his home or her home, and they have a patent that's approved. They must assign the rights to the company so that the company can then have the benefit of that patent. The second one is options, that there would be a structure called a 4-year cliff with 1-year cliff. And this is to entice people to join and stay with the company because they know if they're successful that they will have personal wealth created from the value of their options. Next is that the founder's employees will be employees and be bound by an employment agreement in the term sheet. So no VC wants to invest in a company and all of a sudden the next day have everyone quit and join another company. And they say, wait, that's why I bought the company or bought into the company. So this means that as a condition to the funding, the people that are so important to the business are going to sign agreements that they'll stay with the business. Now, slavery is outlawed in the United States, right? So there are limits to how enforceable some of these things are. We won't go into that at this moment, but suffice it to say that there is a clear expectation that those people that are critical for the future of the company will stay with the company. Next is that we will have a restricted stock agreement for the founders such that the company may repurchase them over 4 years with no cliff. Now that sounds like a lot of legal mumbo jumbo, but it's really important for you to know if you're the founder. Let's say you're the founder and you own all the stock, just to make it easy. It says under this provision that we, the venture capital firm, will fund your business. You will then stay with the business. If you leave before 4 years, we get to buy back your stock at your cost, which gives you a very big disincentive for leaving. And that's the intention of this provision, is that the founders will now have to stay for the time period specified in this restricted stock repurchase, and that is to keep you in the company, plain and simple. They don't even hide that fact. Preemptive right means that the VC firm will fund this round, the $1 million round, and we progress, and let's say 12 to 18 months later, we need more money. And that's kind of expected, no problem to need more money because you're warranting that based on your accomplishments. So under this provision, the VC reserves the right, but not the obligation, to participate and buy their share of the next round. So this enables them to stay current inside to maintain their ownership in the company. Number 9 is liquidation preference. Liquidation preference is very powerful. It means that if the company sells, it will then get a first amount of money before anything goes to the common shareholders. So this is usually with an X, 1X, 2X, 3X, and a 2X, let's just pick 2, means that if the company has been funded $1 million by the VC, that 2 times the million or 2 million will be given to the VCs before any money goes to the common shareholders. So that's the power of liquidation preference. Participation means that once the liquidation preference is met, the next stage is that the VCs will participate with their percentage ownership up to yet another number. So that is called a cap. And we will illustrate this with an Excel spreadsheet, which is much easier to understand than trying to imagine how this would work. But I'm introducing that it is in the term sheet, is very important and powerful, and it really protects the rights and gives upside to the venture capital firm. Next are drag-along rights. This is as painful as it sounds. It means that if the majority of people that invested in Series A, namely the VCs, if they decide on certain items, such as a change in control, to sell your company, that's what change in control is, that everyone else must agree to that judgment. So all of a sudden, the people that are the majority holders of this round now control the major decision of whether to sell or not. And this is a tough provision, but it's in there, right? Number 11 is anti-dilution. This is where if the stock price that is paid by the VC goes down in a subsequent round, you'll make up for it by giving them more stock. Now, this is the most preposterous thing to like normal people. They say, if I buy 100 shares of Google today, and if Google's shares go down in 3 months, can I go back to Google and say, hey, I overpaid for your stock, giving me some more stock to make up for it? And you'd be laughed out of the building. But this is exactly what this says for the VC, that if I pay a certain price per share now, and let's say the next round of financing, the price per share goes down, you, the company, will make up for that by giving me some more stock. I will illustrate this in chapter 14, which is coming up soon, and that will illustrate how the mechanics work for this anti-dilution full ratchet provision. Next is board seats. Here, even though the VC may or may not have majority control of the board, they can ask you to agree to the following. First is that the Heltium VC will have 2 members of the board, and one will be Larry Louie, the VC partner. The other, the VC firm can select. Secondly, the common shareholders will have 2. One is the CEO, and the other will be Kim Kardashian. That's the current CEO. So that we have to hire a new CEO, and that person has a seat. And the tough part is the next one, that one independent member will be the tiebreaker, the number 5 board member. And that person will be selected from a list provided by the VC to you, the founders. In other words, you don't get to pick the tiebreaker, the VC does. And you have to be reasonable in selecting somebody that's qualified to be on the board. And that often makes you uncomfortable. You have run this business the entire time. Now with the signing of one term sheet with one round of financing, you've lost control of the board. You have 2-2 ownership on the board. The 2 you have isn't even yours because one is a CEO that you know the VC will have some say into selecting. And furthermore, the 5th and tie-breaking vote will come from a list selected by the VC. So this understandably makes most entrepreneurs uncomfortable. And the final portions here, registration rights and co-sale. This means that the Series A preferred shareholders can register or push for registration for an IPO. And if there are sales, that they will have rights to sell their share if there was somebody that wants to buy some shares from you. 4th is redemption, is that after a certain amount of time, in this case, the 5th anniversary, they can call you up and say, we want our money back. And you'll have to find ways to redeem their shares. That's a pretty tough provision. Next is other terms, as mentioned, that they want a new CEO. They don't want Kim Kardashian as CEO. So that search will start immediately. Why? Because they're not going to fund until you hire such person. The first 600 tranche is predicated on this. Next is exclusivity, means that once we sign this, you can't take this document and run up and down the street and start shopping it. We call this a no-shop provision. So until you sign the term sheet, I suppose you can shop it, but certainly once you sign it under this understanding with the term sheet, you cannot shop it. Expenses, once we undertake this funding, you, the company, will pay the VC for its expenses, in this case, up to $20,000. Could be legal fees, consulting fees, things of that sort, and you're paying them for their cost. Next is other conditions, and here it says binding. It's going to be due diligence. So here's where we're talking about due diligence as something we'll need to do prior to the final funding of this particular financing. And finally, this term sheet will remain in effect until May 1st, year X. So this is a time period that's usually short. It's in days, not weeks or months. So maybe 2 or 3 days from the meeting that this term sheet will expire. Now that seems pretty tough because 2 days is not a long time. And this is to protect from you shopping, you the entrepreneur. So that short time for us is kind of a take it or leave it type of opportunity or offer from the VCs.